Okay, what if you could basically build your own private pension? A guaranteed paycheck for life, but one that you set up on your own terms. Well, that's really the big idea behind a deferred annuity. It's a super popular tool for retirement, but let's be honest, it's also pretty misunderstood. So in the next few minutes, we're going to break it all down. What it is, how it works, and most importantly, if it's the right fit for you. This is the big question, right? It's the one that keeps a lot of us up at night. I mean, the fear of outliving your money is a very real thing. And that's exactly the problem a deferred annuity is designed to solve. Its entire purpose is to create an income stream you literally can't outlive. So how on earth does it do that? Let's dive in. All right, let's start with the big picture. Forget all the financial jargon for a second. At its heart, a deferred annuity is just a way to create a paycheck for your future self. That's it. It's all about setting up your income for later. So what is it technically? Well, it's a formal contract that you sign with an insurance company. And the deal is pretty straightforward. You give them money now, and in exchange, they promise to pay it back to you, plus earnings, as a guaranteed stream of income that kicks in at some point in the future. The two real magic ingredients here are that tax-deferred growth and the promise of future income. We're going to unpack both of those. So how does this whole journey from a pile of cash to a future paycheck actually happen? It's honestly simpler than it sounds. The entire life of an annuity really just boils down to two key phases. First up, you have what's called the accumulation phase. Just think of this as the growing period. You've paid your money in, and now it's just sitting there, working for you, hopefully earning some solid returns. Then, once you hit that date you picked out, usually when you retire, you enter the distribution phase. It's like a switch flips, and suddenly the insurance companies start sending you checks. Simple as that. First it grows, then it pays. Now that phrase, tax-deferred, is a really powerful engine for growth. See, during that whole accumulation phase, you're not paying a dime of tax on any of the gains. This lets your money compound way more powerfully, year after year, without the yearly drag from a tax bill. Of course, the tax man always gets his due. When you do start taking the money out, those earnings are then taxed as ordinary income. Of course, annuity isn't a one-size-fits-all kind of deal. You've got choices, and they really come down to one simple question. How much market risk are you actually comfortable with? Let's take a look at the three main flavors on the menu. This chart lays it out perfectly. On the safest end of the spectrum, you've got the fixed annuity. It's super simple. You get a guaranteed interest rate, kind of like a certificate of deposit. In the middle, you have the fixed index annuity, which is a pretty clever hybrid. Your returns are linked to a market index, say the S&P 500, so you get more growth potential, but, and this is key, it comes with a floor, so you can't lose your initial investment if the market tanks. And then, for those who are okay with more risk, there's the variable annuity. Here, your money is directly invested in things called subaccounts, which are basically mutual funds. This gives you the highest potential for growth, but it also means you have direct exposure to market losses. Like any financial product out there, deferred annuities have a very clear set of pros and cons. There's no such thing as a free lunch, right? So understanding the trade-offs here is absolutely crucial. The biggest pro is the main promise, guaranteed lifetime income. That peace of mind is really what you're buying. But that guarantee comes at a cost, which leads us to the biggest con. Your money isn't very liquid. This is not a savings account. To get that lifetime guarantee, you have to give up easy access to cash. If you pull it out early, you can get hit with penalties and fees, which can be especially high on those variable annuities. Oh, and that awesome tax-deferred growth? Remember, when you do take it out, the gains are taxed as regular income, not at the lower capital gains rate. And let's talk a little more about those penalties. The main one you gotta know about is the surrender charge. Basically, if you try to take out a big chunk of your money during the first several years of the contract, we're talking 5, 7, sometimes even 10 years, the insurance company is going to hit you with a penalty. It's their way of making sure the money stays put so they can make good on those future guarantees. And it's not just the insurance company you have to worry about. The IRS has a rule too. On top of any surrender charges from the company, if you withdraw any earnings before you turn 59 and a half, the IRS usually tacks on an extra 10% tax penalty. It's a real double whammy, and it sends a very clear message. This is long-term retirement money, not a short-term savings plan. Okay, we've covered the what, the how, and the why, so now we get to the most important question of all. Does a deferred annuity actually make sense for your personal financial situation? So who is this really for? Well, it might be a great fit for someone who wants to create another pillar of guaranteed income, something to go alongside Social Security or a pension. It could be for the person who's already maxed out their 401k and IRA and wants another place for their money to grow tax-deferred. And most importantly, it's for someone who is totally comfortable setting this money aside and not touching it for years. Now, on the flip side, who should probably steer clear of these? Well, if you need your savings to be liquid, for emergencies or big purchases, this is not the place for it. If you have a shorter-term goal, you just won't get the full benefit of that long-term tax-deferred growth. And if the idea of paying ordinary income tax rates on your investment gains is a total deal-breaker for you, you're probably going to be happier with other types of investments. So, as we wrap things up here, I'll just leave you with this question. Building a solid retirement isn't about finding one single magic bullet product. It's about putting together different pieces of a puzzle. Is guaranteed income the missing piece for you? Or is it something else, like maximum growth or total flexibility? Thinking about that is really the first step to building a plan that's truly right for you.